U.S. stocks holding up surprisingly well in light of this morning's disappointing jobs numbers. Could investors be seeing easy money from the Federal Reserve in our future? Liz Faublas is at the New York Stock Exchange with today's highlights. Liz.
Hello, Pimm. Well, you are absolutely right. The U.S. losing more jobs than economists had forecast. 95,000 jobs lost. Now, to put that in even more perspective, we were expecting a decrease of 5,000. So suffice it to say, that really caught Wall Street off guard. We have the unemployment rate. Now, that didn't budge. It's holding at 9.6%. Still, the jobless rate has equaled or exceeded 9.5% for 14 straight months. That's the longest span of elevated joblessness in recorded history. Now, Pimm, when you see results like this, it just underscores the Federal Reserve's concerns that the recovery is slow going and may require easier monetary policy, like you mentioned. Now, here's the thing. With all that said, the stock market finding support in speculation that the Fed could fire off more stimulus measures. The major averages all closing higher, with the Dow above 11,000 for the first time since that May 6th flash crash. The S&P and the NASDAQ also higher. Also bolstering some confidence today, we had investors saying that the Fed would join the Bank of Japan in taking steps to safeguard the economic recovery.
Now, Liz, let's just talk about dividends for a moment. Investors obviously would prefer to see more of them, but where should they be looking right now?
Well, Pimm, it's looking more and more like the best alternative for shareholders looking for better dividends is the information technology industry. Now, it used to be financial stocks, but that was until the third quarter. IT stocks accounted for 9.2% of the almost $210 billion in dividends paid out. That's as of yesterday. Now, that's compared with the 8.9% for financial stocks, and that's according to data compiled by S&P. Now, S&P analysts are saying that tech has excess cash and the ability to pay, whereas financials, it's going to take them a little bit longer to get back to where they were. So ultimately, what we're seeing is companies like Cisco Systems and Microsoft, which generally have held on to the cash so they can reinvest it in research and development or make big acquisitions. Well, now they're just choosing to pay out some of that cash by introducing or increasing dividends to satisfy shareholders that are starved for more yield. Back to you, Pimm.
Thank you very much. Liz Faublas reporting from the New York Stock Exchange.